Welcome back to the Pro Trigger Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
And the calendar really feels appropriate today. Friday the 13th, February 2026. If you're a superstitious trader, I mean, the way this week has gone is probably just confirming all your worst fears.
It has been such a messy week. I was looking at the heat maps just before we came on, and the split is just, it's stark. Total sea of red for Wall Street. But then you look over at Asia, and it's just glowing green.
It's like two different planets.
Exactly. Two completely different realities.
But the thing is, they're both reacting to the exact same thing, AI. It's just that one side of the world sees it as this, existential threat, and the other side sees a gold rush.
Right. And that's what we have to unpack today, this whole idea of the AI scare trade. We're digging into how investors are just dumping U.S. software, dumping services stocks, because they're terrified of efficiency, basically.
While at the same time pouring all that cash into Asian hardware. It's the classic fear versus greed. Fear of disruption on one side, greed of enabling it on the other.
And we've pulled together a bunch of reports to figure this out, Bloomberg, CNBC, Yahoo Finance, to try and piece together this whole global puzzle. We have to talk about what they're calling the SaaS apocalypse. The rush into chip makers like TSMC, and of course, Apple's just terrible day on Thursday.
And the geopolitics are really heating up. There's a huge new trade deal between the U.S. and Taiwan that has Beijing seeing red. And this proxy war, a literal proxy war over the Panama Canal. It reads like a spy novel.
Okay, we will get to the spy novel stuff because that Panama story is just wild. But let's start with the pain here in the U.S., this market rout. S&P 500 down for 3 straight days, NASDAQ getting hammered. For like 2 years, the story was just buy AI, it's the future.
And now, almost overnight, the story has flipped to sell everything else because AI is going to destroy it. Yahoo Finance coined the term AI scare trade, and I think it's perfect. We're moving out of the hype phase and into the, deployment phase.
And deployment is scary.
Well, it turns out deployment is deflationary for a lot of businesses.
Okay, let's get specific, though. It's not just tech stocks. It's really specific sectors getting hit. Software, real estate, and logistics.
The software pain is the most immediate. People are calling it a SaaS apocalypse, and I don't think that's an exaggeration. Think about the whole business model for the last decade. Software as a service.
The per-seat model.
The per-seat model, exactly. You charge per user. Your whole business depends on companies hiring more people so they buy more of your licenses.
It was the holy grail, great margins, recurring revenue, all of that.
Yeah, but now the big fear is that AI agents, these autonomous bots, they don't need a seat, they don't need a user interface. So if an AI can manage your sales pipeline or write code better than a human using a SaaS tool, why are you paying for the tool?
So it's not just sentiment. This is a fundamental repricing of the entire business model for these companies.
It's an existential threat to seat-based pricing. And that fear is now spilling out into the physical world. You mentioned real estate. Elon Musk was talking about this again. His logic is pretty brutal.
I saw that. It's basically, if AI replaces all the white-collar paper pushers, you don't need the skyscrapers they sit in.
Which is just terrifying if you're in commercial real estate. But the logistics example you flagged, that one from the reports, that felt the most real to me. Algorithm Holdings.
Yes, that was the core of the CNBC story. They just dropped a bomb on the whole sector this week. They've got this new AI tool for freight forwarding.
And the claim was just staggering.
It was. They said their tool lets clients scale up freight volume by 300% to 400% without hiring a single extra person. Now, I have to be skeptical here. Companies always say, we boost productivity by 20%. Why did the market lose its mind over this one?
Because of how it does it. This isn't just, slightly better route planning. That's old news. This tool automates the entire brokerage and negotiation layer.
So not the truck driver. It replaces the broker, the person on the phone.
Yes. The human coordinating everything. It matches loads, it negotiates rates with truckers, it handles the billing, it even resolves disputes, all of it autonomously. It severs the link between revenue growth and headcount growth.
So if you're a C.H. Robinson, your whole model just broke.
Instantly. The stock was down, what was it, 23% intraday?
Something like that. It was a bloodbath.
And it's not like C.H. Robinson is losing money today. They're still moving stuff. But investors are looking 5 years out and saying, your margins are gone. You're a typewriter company in 1985.
Okay, but there has to be a counter argument, right? I mean, CNBC talked to Matt Garman, the CEO of AWS. He seemed to think this was all a bit much.
Well, of course he does. He's selling the shovels for this whole revolution. But yeah, his point was more nuanced. He called the fears overblown. He argued that the sauce companies that actually adapt and integrate this stuff will have the inside track.
So adapt or die.
Pretty much. He did admit that if you stand still, you're a dead company walking. But he thinks that the big platforms, the ones who own the data and the cloud, they'll just absorb the smaller players. It's not the end of software, it's a consolidation.
So if you're just a middleman, you're toast.
Mm.
But if you're a major platform, you might survive.
Precisely. And that's the split, right? The tool users versus the tool builders. And that explains the big divergence, why the panic in the US is fueling a massive party in Asia.
Let's go there. Let's cross the Pacific. Because while the US is selling, Tokyo, Taipei, Seoul, they're all buying. The MSCI Asia Pacific Index is up over 12% this year alone.
Bloomberg had a really smart take on this. They called it the upstream theory.
Yeah.
The idea is that global investors, they look at the chaos in U.S. software, right? They have no idea if it's going to be ChatGPT or Claude or Gemini that wins.
Right. You don't know which horse to bet on.
But they all need to be fed. They all need chips, a massive, massive amount of computational power. So the money just flows upstream to the enablers.
It's the classic pick and shovel play.
And Asia owns the entire shovel factory. I mean, look at TSMC in Taiwan. It's now approaching a 45% weight in their main stock index.
Wait, 45%? That can't be right.
It is.
That's not an index anymore. That's just a TSMC tracker fund with a few other stocks sprinkled in.
It's a singularity. The entire market is just a leveragey bet on one company. And it's similar in Korea. Samsung and SK Hynix make up almost 40% of the Kospi.
And I saw Kioxia in Japan just popped 15%. So the logic is, the further away you get from the end user, the person who might get replaced by the AI, the safer your investment is.
That is the trade right now. As one fund manager told Bloomberg, all AI roads lead to TSMC. If you're upstream, you just collect the tolls. You don't care who wins the war downstream, you just sell them all the bullets.
You know, there was another really strange divergence in Japan that was mentioned. We were just saying how U.S. real estate and insurance are getting hammered. But in Japan, those same old school sectors are actually going up.
It's the great irony of being behind the times. Japanese insurance firms, real estate firms, they are famously slow to digitize. I mean, they're still fax machine heavy, paper heavy businesses.
So they're too analog to be disrupted yet.
In a weird way, yeah. Their lack of tech is a protective moat for now. Investors see them as insulated from the immediate AI agent threat because their workflows aren't even on a computer to begin with. It's buying them time.
That is wild. Lagging on tech is now a stability strategy. Okay. Speaking of lagging, we have to talk about Apple.
Oh, yeah. Rough day for Tim Cook on Thursday.
Apple sank 5%. That's their worst day since, April of last year? And it feels like this was a real double whammy. It's a product problem and a regulatory problem hitting at the exact same time.
Let's start with the product. So Bloomberg is reporting the big AI update for Siri, the one everyone's been waiting for, is delayed.
Again, I feel like this has been coming soon for years.
It's delayed again. Internally, it's been pushed to May, maybe later. And that's a huge deal because the whole bull case for Apple is this upgrade super cycle, right? The idea that you have to buy the new iPhone to get the real AI.
But if the AI isn't ready, the super cycle doesn't start.
Exactly. And your competitors are moving so fast. But that wasn't all. On the same day, a letter from the FTC lands on Tim Cook's desk.
This is from Andrew Ferguson, the FTC chair, and it's about Apple News. The allegation is that their algorithm is suppressing conservative news sources.
Now, politics aside, from a pure investor standpoint, this is just a massive headache.
Oh, absolutely. It's regulatory risk. An FTC inquiry is not a small thing. It can mean fines, investigations, maybe even forcing them to change how Apple News works. And investors just hate that kind of uncertainty. So you got product uncertainty and political uncertainty on the same day.
And that's how you get a 5% drop in a trillion-dollar company.
So let's stick with the politics, because this is really a through line this week. While Apple is dealing with D.C., D.C. is making huge moves with Taiwan. And this is way more than just defense pacts. This is deep economic integration.
It really is. The U.S. and Taiwan just signed a trade deal that's, well, it's unprecedented. The top line number is that Taiwan is getting rid of tariffs on 99% of U.S. goods.
99%. That's basically free trade.
It's what they're calling preferential market access. In return, the U.S. is lowering its tariffs on Taiwanese goods. And Taiwan has committed to buying over $84 billion of American stuff energy, planes, food over the next 4 years.
Sounds like a big win for U.S. exporters. But there's always a catch. The sticking point has to be chips, right?
It always comes back to the chips. Commerce Secretary Howard Lutnick is demanding something that Taiwan's negotiators are flat out calling impossible. He wants 40% of Taiwan's entire semiconductor supply chain moved to the U.S.
Whoa, hang on. Not 40% of the finished chips, the whole supply chain.
The whole supply chain. The specialty chemicals, the testing equipment, the packaging, the companies that supply the suppliers. It's this incredibly dense ecosystem that's all built up around TSMC.
And Taiwan's basically saying, no way.
Their negotiators pushed back really hard. They said you can't just pick up an ecosystem that took 30 years to build and drop it in the Arizona desert. The skilled labor isn't there. The supplier network isn't there. It doesn't work.
And you can imagine Beijing is just thrilled watching the U.S. and Taiwan get this cozy.
Thrilled is not the word. No, China immediately slammed the deal. They said the U.S. is hollowing out Taiwan's economy and, of course, violating the One China principle. They see it as the U.S. trying to absorb all of Taiwan's value.
It's a race to integrate, which is actually a perfect transition to our next story. Because if you think the fight over chips is tense, what's happening at the Panama Canal has gone completely off the rails.
This story is amazing, and it's getting buried by the market news, but it's a huge geopolitical move. It's a proxy war for control of the canal.
So set the stage for us. You've got the Panama Canal, obviously one of the most important trade choke points on the planet. For almost 30 years, the ports at both ends were run by one company, CK Hutchison.
Right, which is a massive conglomerate based in Hong Kong. They've been there forever. But the U.S. has gotten more and more nervous about a Chinese-linked firm controlling the gates to a canal that handles, 40% of all U.S. container traffic.
So out of nowhere, Panama's Supreme Court gets involved.
And rules that CK Hutchison's original contract from the 90s is unconstitutional. Just like that. After nearly 30 years, they retroactively void the deal.
That does not sound like a coincidence.
No, the timing is, let's say, convenient. And here's where it gets really messy. Panama immediately invites a subsidiary of Maersk, the Danish shipping line, a huge Western company, to step in and take over the port operations temporarily.
So it's a corporate coup, and I'm guessing CK Hutchison isn't going quietly.
Not at all. They send a direct legal threat to Maersk, basically said, if you touch our port, we will sue you into oblivion. And they've started an investment treaty dispute against Panama itself. They're digging in for a fight.
And Beijing is backing them up.
Oh, yeah. Beijing warned Panama they will pay a heavy price, both politically and economically, for this. So Panama is caught between the U.S. wanting to push China out and China threatening to punish them if they do.
And Maersk is literally stuck in the middle.
Yeah.
Can you imagine being the port operator there? You're trying to dock ships while lawyers are flying around and superpowers are making threats?
It's a recipe for chaos. It just injects massive uncertainty into the supply chain, which is the last thing anyone needs right now.
It feels like the physical world is becoming as contested as the digital world.
Mm-hmm.
We're fighting over chip fabs and we're fighting over shipping ports. Okay, let's do some quick hits before we wrap. What else is moving this Friday?
Top of the list, CPI, the inflation numbers. The whole market is just holding its breath for that 8:30 a.m. print. The expectation is 2.5%.
And if that comes in hot, with the Fed watching so closely, this market sell-off could get a whole lot worse.
A whole lot worse. Also, just to show you that the AI scare is really just a public market thing, the private money is still flooding in. Anthropic just closed a massive new funding round.
How massive?
$30 billion.
Yeah.
At a valuation of $380 billion.
Wow. $380 billion for a private company. That's just mind-boggling.
It really shows the split, right? The stock market is panicking about AI destroying old companies, while VC is still throwing unbelievable money at creating the new ones.
And speaking of new companies, the EV war in China. I saw the January numbers for Xiaomi, the phone company that now makes cars. They are just destroying Tesla.
And numbers are wild. Their new SUV, the YU7, sold almost 38,000 units in 1 month. That's double what Tesla's Model Y sold.
And the Model Y fell to 20th place. That's not just slipping. That's a total collapse for Tesla in the biggest EV market in the world.
It just shows how fast things move in China. If you're not iterating like a software company, you're dead.
Last one, a quick check on Moderna.
Yeah, not a great day for them. The FDA rejected their new flu vaccine. Stock took a hit. A good reminder that in biotech, the regulator is always the final boss.
Okay, so let's try and wrap a bow on all of this. It really feels like we're in this incredibly messy, painful transition.
That's exactly it. We're moving from the promise of AI to the reality of AI. And the reality is that disruption is ugly. It breaks business models. It empties office buildings. It forces geopolitics to the front page.
It's a huge wealth transfer to the hardware makers in the East who sell the gear, while everyone in the West who uses the gear is trying to figure out if they still have a job.
And underneath it all, you have this great power competition. The US and China are forcing everyone, from chip makers to port operators, to pick a side. There is no neutral ground anymore.
So I'll leave you with this final thought, and it's based on that algorithm example. Let's say AI really does make logistics 400% more efficient. That's a massive productivity boom, eventually. But in the short run, that efficiency looks an awful lot like a massive recession for all the incumbent companies in the S&P 500. So which is it? Are we heading for a recession caused by obsolescence or a productivity boom that we just don't know how to measure yet?
That is the trillion-dollar question, isn't it? And while we're waiting to find out, my advice would be to keep an eye on who owns the physical stuff, the ports and the chips. It seems like the only safe place to be right now.
A lot to chew on over the weekend. We will be watching that CPI number very closely. But that's our deep dive for today.
Stay safe out there, everyone.
We'll see you all Monday morning with new headlines from major financial magazines.